On this episode of the Stock Market Playbook, we've got Bobby Iaccino, and he talks about his 33-year trading career, how he approaches the market, some of the things that he looks at that other people aren't looking at. And we throw in a pretty interesting oil kind of gasoline relationship discussion, which I think is pretty interesting given what we're seeing in that space. Enjoy this episode. You're going to love Bobby. He's got some great things to talk about. Okay, Bobby, thanks for joining us. We're happy to have you on the episode of the Stock Market Playbook today. You and I were chatting a little bit offline before we started the recording. You've got quite a history. Everybody loves to kind of hear that. And I love to hear that. I love to kind of know where people have come from, how their journey has been, and so on. So you're pushing 40 years old, but you've had a solid career. We were talking about your early start. Funny enough, I don't meet people. We don't have guests on the podcast that go too much before me. I'm about 2001, so you got me beat by a couple of years in the market. So tell us a little bit about yourself and your early career and how you got where you are.
Well, first of all, thanks for having me. I actually love to talk to this demographic because I heard something the other day that reminded me of some of the younger traders that I speak to nowadays. And the line was, and I don't know who actually originated the quote, but it was young people don't know anything, least of all that they're young. And that sounds like an insult, but it's really not. I was at the car wash the other day, and the kid that rang me up and pushed me through the car wash asked me what I did for a living. I told him, and he started talking to me about Fibonacci's. Literally, the generations that's 2 and 3 years after me. I mean, I'll be 60 in September. I know I look great. Let's just get past it.
Nice work.
Yeah, he literally was 18, 19. None of us in my generation were looking at stocks, crypto, obviously it didn't exist, or anything else when we were 17, 18, 19 years old. So these kids are going to be way more wealthy and way more better off than we are. So I really love talking to this audience. I started in 93 down on the trading floor at the CME group in Chicago, down on Wacker Drive, the old CME trading floor. We spent some time at the board of trade as well. I went from being a runner to a clerk to an institutional broker to an independent trader, back to being, because I lost, as I told you, 6 figures in like under 9 months. I went from being that, I went back to the institutional world. I was an assistant market strategist, a chief market strategist, worked for Nico Securities, Commerce Bank, Smith Barney. And then I went to be a risk manager at a prop trading firm in Chicago. From there, I invested in a fund of funds that a friend of mine started, became a principal of that fund of funds, and then joined the investment committee for that fund of funds, where I allocated money to different money managers. And that gave me sort of the insight to understand some of these new managers. I was actually in charge of what we called emerging manager allocations. Emerging managers was somebody with 3 years of track record or less. So people will come up to me now and they'll be like, so I've been trading for 6 months. I think I got a strategy. It's like, okay, I'm positive that you do, but you need more time. Most of the people I talk to don't even remember the Fed in not intervening in the markets by managing interest rates. I actually remember that. So there's a lot of things that have changed.
Yeah.
So yeah, that powers and sort of colors the way that I trade now, because on the trading floor, I was in and out of trades within 30 seconds to a minute. Now my average hold time is 26 days.
So what is your market of focus now? Where do you spend most of your time?
Well, I will tell you, I spent 4 years at an oil firm doing geopolitical strategy, hedging strategy, and then I ran the in-house stock options fund. I trade everything. The thing I still trade more than anything is crude oil, believe it or not. But it's about 32% of what I trade. So it just happens to be the largest chunk. I trade individual stocks. I trade ETFs. I trade index futures. I trade commodity futures. I own a lot of physical gold. So I literally am all over the map.
Yeah. What is how would you classify your approach to the market?
So a lot of people like to have these names for what kind of trader they are. They're a day trader. They're a long-term trader. They're a swing trader. I'm a trader. And what I mean by that is I have trades that I'm in and out of in 6 hours. I have trades that I'm in and out of in 6 weeks, 6 days, 6 months. I have 3 main strategies, and I get out of them when my targets are reached or my stop is reached. I don't care about the time necessarily. There are a couple of times during certain patterns where I'll say, okay, this is long in the tooth and the probability of it reaching its target has gone down, and I'll look for a logical exit from it. But time is not necessarily a factor for me. People, Jared, think getting in and out of the market means you have less risk. I disagree. I think having smaller position size and widening your boundaries out is how you control risk. Risk is controlled by position size, not by time in the market.
Sure. So your key metrics you like to look at are you do you mix technicals and fundamentals and sentiment and or do you focus on one more than the others?
So I come up with a fundamental thesis. Well, let me start from scratch. I look at 29 charts every morning, and I have two models that I run for the stock market. Those 29 charts are mostly commodity FX interest rate related. Then I run two separate models, okay, a weekly model and a rotation zone model. And sometimes those things will kick out 12 stocks. 2 weeks ago, it kicked out 48 stocks. So after I do my core 29 charts, I go on to what my models have kicked out. Now, the weekly model, I don't have to look at it every day. I look at probably every 3 or 4 days because the triggers for that will come on a Friday close. But the rest of it, I do every single day, every single morning. It's just what I do. When I'm taking time off, I just shut everything down. I don't even look at the markets, so I don't run models or anything. But outside of that, that's my approach. Oftentimes with a lot of these things, I'll have a fundamental opinion on something. I'll give you an example. Remember the Chipotle E. coli thing?
Oh yeah.
Okay, so I was still living in Chicago at the time. I'm down in Southwest Florida now. And I remember driving toward the exchange and I'm listening to the story about the E. coli problem at Chipotle. And around lunchtime, I pass a Chipotle and I see a line out the door. I pass a second Chipotle and I see a line out the door. And I call my partner up. I'm like, we need to buy Chipotle. And he goes, not yet. We bought it 3.5 years later because the charts would not give us a green light to get in it. So the fundamental can always be excluded by the charts and the price actions. It has a veto over anything that I think about a particular stock or sector.
Gotcha. That is interesting. I always think it is, I find myself looking at, I mean, that's kind of been a side thing that a lot of people talk about, right? Like, is this store busy, right? I love Lulu. Lulu's always just busy, Lululemon, right? For anybody watching. Every time my wife needs to go, every time, I have to return something, whatever, there's always these crazy lines and their stock just can't catch a bid, right? There's these dichotomies that happen here. GameStop is an interesting one as well. I've got kids and one of my sons loves going into GameStop and it's always just full of people, but I'm like, the stock, it's fallen off a cliff. So you've really got to take everything into account. So what are some of the elements, without giving away your secret sauce, what are some of the elements that your models look for? Are you, is it heavily financially metric based or where does
the
that
models
come from?
search entirely for price patterns. So I can spell one out for you. In every time frame that I look at, which is weekly, daily, 4-hour, and then I go down to the hourly and the 30 minutes sometimes to fine tune entries on certain trades. But the rotation zone model looks exactly for that. It looks for price entering what we call the rotation zone. The rotation zone is very simple. It's an 8 exponential moving average and a 21 exponential moving average. So in order for those two to form, or I don't give a crap. Can I cuss in this? Because I cuss a lot. Look at my last name. I cuss. I don't give a shit about moving averages crossing. They virtually mean nothing to me. But when they start to angle up or angle down and the 8 and the 21 start to widen while they're angling, right? That's a rotation zone for me. So if you imagine my hand is the 8 and the 21's kind of widening and they're moving on an angle up, price will go up and move away from the 8. And when it comes back down into that, now I'm looking for a rotation back up. So I will look to see if that rotation happens. And if that rotation happens, I'll get in. So my one model finds all the rotations for me. It searches 7,912 stocks and finds those rotations for me. Then it's up to me to decide if the model has picked out what I'm looking for or not. And the good part about that for me is, like, a lot of people bottom fish, right? I don't bottom fish. the way that I look at it, Jared, is if I want to get on a train going north, I don't get on one going south, wait for it to get to the station and turn back around, right? I'll go on the north station and wait for a train that's going in the direction that I want to go. I don't believe in bottom fishing because, again, that's about how I lost near six figures in about 9 months, is by buying things and saying the market's wrong, this is a good buy. I wait for the market to tell me, looks like it's turning into a good buy, and then I get in there and the rotation zone will show me that.
Interesting. So that makes sense. There is so much risk in buying the big dips, right? And I think there is some confusion, and it's a good thing to bring up, right? When you say bottom fishing and buying these stocks that are down really low, I mean,
Yeah,
really what that is buying into typically a pretty big downtrend,
right.
right? And so the old adage, don't go against the trend, don't fight the trend, don't fight the Fed, right? All these things. And they have quite a bit of merit to them. Those are always risky things to do. But I think it's interesting how you say you buy the dip, right? So that's your kind of rotation zone. Something's pulled back to some of these shorter term moving averages. And
Well, I
is
should
that your
correct
signal?
something. So I wait for a dip, but if the dip continues, I don't buy it. I wait for a dip and a rotation. So once that rotation comes, I'll buy it on the way back up. I don't buy it on the way down. It's actually a pretty simple concept if you see it visually, right? Where something goes into a rotation zone and then starts to move back up. I'll draw a little downward sloping trend line on the down move that happened in the rotation zone. And when it breaks that trend line, that's when I get in. So I don't actually buy the dip in the rotation zone because the rotation zone can fail, and it often does. But it forms, and when it forms, you can get high probability rotations out of it again. So I don't know if
Hmm.
that makes sense. I could actually show
Yeah.
you if I could share a chart here, but
Go ahead. Share a
yeah, let me
chart.
see if I can. I should be able to quickly find one, for example, like with the Qs in the last rotation, not the recent run, because there hasn't been a rotation in the recent run, right? So if I pull up this chart, I'm going to put up the Qs and I'm going to go back in time a little bit here. Okay. Tell me when you can see this.
Okay, I got you. Gotcha.
All
Coming
right.
through loud and clear.
So the orangish one is the 8 and the bluish one is the 21. Again, they're exponential moving averages, as you can see here, right?
Yep.
Here's where they crossed down here. I don't care about that because, you can see in areas like this, they cross all the time and there's nothing that happens with it, right? But here, for example, you had a cross and here they start to angle and widen. Here you had to move into the rotation zone. Here you had to break out up. I might get long here. This is a better example than this is. So when I see it, I'm going to zoom in on this area right here. Okay. And expand it a little bit. Here we start to get a move into the rotation zone, right? I will then take just a simple trend line tool and draw what I call a best fit trend line. Okay. And when I get a close above the trend line, I'll get long and then subsequently ride it here. Same thing would happen here, but there was no suitable trend line for me to draw. So I'm not in on that kind of a trade. This one, however, I can draw a suitable trend line, right? Close above happened right here on the 22nd. I can get long again, right? Now, this one would have stopped me out because my stop would generally be below the low of the lowest candle that went into the rotation zone, which went here and stopped me out. That's no problem. That happens. But then I've got another one here, right?
Mm-hmm. Mm-hmm.
So it happens a lot in a lot of different assets, in a lot of different indexes. And I don't mind showing it because it just becomes more self-fulfilling the more people I spread it to. But we looked at
Sure.
about 20 years of data of this stuff. So over 20 years, you can see that it happens enough time for that to be a reliable entry. Now, other things come into play. I also use GAN extensions and retracement extensions. I don't use FIB, I use GAN.
Sure.
GAN, again, test it out better. If we're coming into an earnings play, I won't do it around earnings. So there's other things that happen. And also with all of the other things I trade, not stocks, but with everything else, 4 to 5 trips in the rotation zone, it starts to weaken. So I don't do it
Mm-hmm.
anymore. But with stocks have a natural upward bias from all the long only mutual funds and 401ks and Roths that are just going into stocks. So I'll still continue to do it if the trend seems strong. But that's a very simple entry point for me when something is trending in a new direction.
What's a typical entry type that you would take on that? Would you buy call options, shares, some sort of spread, some sort
It's
of
always
flip?
shares for me. It's
Always
always
shares.
outright shares. And that comes from my experience on the trading floor. You know, as I mentioned to you early in the conversation, I don't really care about time. Therefore, speculative calls and call spreads, I do them, but usually I will do those long dated on a longer term play that I like. For example, I'm currently building a pretty solid long position in Tesla. Why? Because my strategies will not allow me to get into IPOs. And I think the SpaceX IPO is going to be massive. And I think Tesla is going to go up in sympathy. I really do. So I'm building a long-term position. In Tesla, I'll buy some 1 year out call spreads. I haven't done it yet. I may do it today, depending on what the vol has done. But I already started building the shares position in it. And it'll take me probably a few weeks to build the position I want to build. It's going to be a deep into 5 figures position. And I want to do it slowly and I want to do it deliberately. I'm nowhere near where I want to be on it. But as I start to profit on it, I may sell some covered calls and I may actually go further out and buy some way out of the money call spreads if I continue to feel good about the trade.
Gotcha. That's interesting. I do think there's some good stuff to watch there. That IPO is going to be massive. I probably have gotten, I don't know, 1,000 emails and text messages and phone calls from people saying, I got an email saying I can buy into the, some private shares on SpaceX. And I always say,
yeah, you can't.
You're 89 years old. Just sit on the sidelines for a minute.
All you got to do, how long was the email, right? I mean, if it's scrolling and scrolling, we're about to reveal how you can do it. But first, let me tell you about when I was a kid. Just delete it. Please delete it.
The sales pitch stuff is great.
Brutal.
I love it.
Absolutely brutal.
So how in your strategy, so obviously you've been at it for, I mean, what is that? 30
it's like
some
33,
years?
coming up on 33 years.
33 years. Have you begun to or already or are against incorporating AI into your strategies? How does that help the research, help the analysis, or not at all?
So I'm working on an AI model to search for more patterns that we like. I like to trade high probability double tops and double bottoms. What makes them high probability? What's parameters that we created through 20 years of research, right? In a blanket statement, double bottoms are not there just because there's 2 bottoms. There's all kinds of parameters that make them high probability or low probability or non-existent. For example, you have to be reversing a prior trend to have a double bottom. So there has to be a long down move moving into the double bottom. A lot of people will see 2-3 candles lower and then 2 bottoms are like it's a double bottom. No, it's not. And I can show you in the research how it doesn't actually extend to the taught measured moves that you can get from double bottoms and double tops. I need to have a stop and a target and a calculated in entry on every trade or I don't get in them. I think searching for targets is a completely underappreciated part of trading. Everybody knows I got to have the right entry. Everybody knows about stops. Some people use them, some don't. Targets are really important. A lot of people in the retail sphere get into trades and they go, I'm just going to hold it until I don't think it's going any higher. That's dumb. But targets are complete. And by the way, targets don't have to be a place where you cover a trade. A target is a place where an action is required. Maybe you move your stop. Maybe you take a portion of the trade off. Maybe you add to it, depending on your strategy. Anyway, I'm getting off your question. I'm starting to put AI models together to try and test out finding doubles because we have doubles down to being about 68% probable.
Yeah.
And that's high enough for me to do almost anyone I see. The second part of it is tweaking targets. Stops, we have a very robust method of placing our stops. And it's multifaceted, so it's difficult to explain on a podcast. So I'm not doing anything with that yet because one thing, AI is only as good as the data it was trained on. So it's very difficult for me to give this over to AI at this particular stage.
Sure, sure. Yeah, that's definitely an interesting part of it. I think that's where a lot of people, especially traders. I mean, it's there's so much power there, but it is important for everybody to remember that it's an input output kind of situation, and if the inputs aren't great, the outputs aren't great, and so
And since Jared,
uh,
since we talked about it already, be very careful of emails you get that say we have an AI strategy that learns and adjusts with market. When President Trump got shot in the ear, I was looking for a concise story on what happened, and I went to 3 different large language models, and this was 2 days after the fact, and one of them I saved. I printed it out. I said, "Give me the latest news on President Trump's assassination attempt." President Trump has not been shot. All 3 of them said that. They all said there has been no assassination attempt on the president. Excuse me. And one of them, I actually pasted a story, and it said, "Thanks for that news, but I can't confirm that's factual." You're not working with an infallible set of technology here. And so you have to
sure.
be really careful with that stuff at this stage.
No, that's a good point. That's a good point, and we definitely, it's. I think the stock market can be a little misleading in that space. We think, hey, stock market's going up, it's going down, but we have done. I've had quants working for me and for my fund for years, and
Mhm.
and data quality is
It's
quite a
huge.
big thing. But that's interesting, and I do think certainly for the smaller groups and shops and the individual trader and so on, there's a lot of kind of parsing out some of the noise, and AI can be super helpful for that. And there's certainly a lot of benefit
Right.
to traders. But you're right, you got to take it all with a grain of salt and
Mhm.
verify the information it's coming up with. But it's a great idea generator, and a helpful tool for back
Yeah, I
testing
think
some of
as
these
long as
things.
people are using it as a tool as opposed to a crutch,
Yeah,
I think it's
yeah,
definitely beneficial.
no, absolutely. What are some of your favorite market themes right now? Because as I look at, if we just take, for example,
Yeah.
four of the big guys, right? Let's just say the S&P, the VIX, crude oil prices, 10-year yield.
Mhm.
There's these guys all work. One of them at one point or another usually gives us a signal of something that might be coming. I'm not suggesting anything, but
Oh, they
as I
all
look at
work in the
those,
same restaurant, Jared. That's basically what it is.
that's
They
right,
work
that's right.
together.
I look at those and I think this looks interesting. What's your near term view? I mean, we're in May. We've got the old fashioned adage that I don't know if it applies anymore. Sell in May and go away. We've got some, pretty new highs. We're just a little bit off highs on the S&P. Where do you see things going in the next few months?
So sell in May and go away has been tested over and over again, and there's something to it. But there was some recent work, I forget by who, it might have been Singleton, that is basically breaking, right? It has a lot to do with things like zero DTE options and other things that have been happening. The retail community has really put a dent in some of the historical and seasonal factors in the markets. Retail believes you buy every dips, and subsequently the dips are not lasting as long, right? Now, granted, we've only had a couple since COVID when they really bought the dip, but um, I think when I'm looking at it now, the biggest thing to me is still crude oil by far. And there's a couple of reasons for it. I remember when crude was a really big story in 2015 and 2016. And as you know, the futures price went negative a little bit after that.
Yeah,
And people were like, when the prices go up, they'll just turn the spigots back on. I worked at an oil company. You can't just turn spigots on. It's just not how it works. You can't just say, oh, prices are high, let's produce more oil. Especially when you look at the Permian. Now, the Permian is chugging along right now, record production after record production, but we only have a certain amount of refining capacity and we only have a certain amount of storage. So at some point, if the demand for the type of oil we produce here in the US doesn't increase, right now it's fine, but it needs to increase or they're just going to have to stop producing. We have not been energy independent for as long as uh, all the previous White Houses have said we are or can be. Crude oil is not fungible. Okay, there's light sweet, there's oil sands, there's black tar, there's sour, there's different types of crude oil, and they come from different regions. I'm going to get a little political, not in the sense of supporting one or the other, because I don't give a crap about that. Venezuela came before Iran for a reason. And it's because Venezuelan crude is the same type of heavy sour crude that comes out of the Strait of Hormuz. Now, Venezuela right now is trying to convince the oil companies it's safe to come back and get their oil industry back up to where it was. They also have the biggest untapped reserve in the world of crude oil. The refineries we have, mostly in the Gulf Coast, are mostly set up to refine that sour crude, not the WTI that we export. We don't use much of it. We export most of it. So we have buyers for it right now. When the Strait of Hormuz reopens, it is not simply going to be crude oil back to $50 for a number of reasons. Number one, you think about what's in the Gulf and its tankers. How many tankers are there? A limited number. Most of them are now full, being used as waterborne storage. Then there's storage tanks on land for the UAE, for Saudi Arabia, for Iraq, for Iran. Those things are starting to fill up. What used to happen is you used to get crude oil barges that went out of the strait, emptied, and came back empty to take crude oil out of the storage tanks and then go back out to sea again, and you could just continue. So at some point, my estimate is 2 weeks, Iran will have to start shutting wells, and so will Saudi Arabia, the UAE, and probably Iraq. Saudi Arabia and the UAE have pipelines, but not enough. So they're able to ship some crude oil out. When they do that, damage to wells is not just a possibility, it's imminent, especially with that type of crude oil, because there's something called crude wax that forms from that sour crude oil, starts to come up to the ground. It's not being pumped. It surpasses the good oil, and it plugs those wells, and they have to be re-drilled. So you don't just get, there's this simplicity of crude oil to the average person. If they announce tomorrow the strait is open, okay, cool. Why aren't crude oil prices going down? Because it takes a lot of time. My calculations are 7 to 12 months at this point already to get normal flow of crude going. And every day that this goes on, it gets longer and longer exponentially, not just by a match of one day. So crude oil to me is still the biggest thing. And with some of the price increases, this particular bout of inflation can't be fought by the Fed. It's going to be fought by the recession that it's going to drive us into if it continues too long.
That's a good take. That's an interesting take. And I think, certainly a lot of my listeners of the podcast and people I talk to, that's a very popular opinion, right? If oil production is up, then prices are down, right? And it's, we always see that, I still think it's so interesting how the general population judges the economy on price per gallon, right? Yep. That's such a in-your-face number everybody can look at, and they can say, okay, we're above 250. Things are strained, and everybody has a dad, right, that will drive like 30 miles out of the way to save 5 cents a gallon. Yeah. And it's, the lines at Costco so you can save 10 cents a gallon or whatever. And when you think about that, you go, did you just save like $5 on an entire fill up, AKA a Starbucks or something, right. And so oil is such an interesting thing. And obviously the corresponding gasoline prices that go with that. And people say, well, oil prices go up, gas prices go up immediately. Oil prices go down, gas prices don't go down immediately. And everybody thinks, okay, there's some fishy business here. But it is interesting. I've had a lot of clients that have been oil related. And you're right. This is not a on and off switch kind of situation.
It's not. And even the price at the pump, Jared, I mean, gasoline, I'm already going to forget the term. There's a term for the people who buy the gas for the gas stations. There's a middleman, right? And essentially they buy for months at a time. Okay. So when the price of crude oil goes down on the CME or the price of Brent goes down, you're not going to see that in your gas station right away. Now you'll see the price going up, right away, because the gas stations know that their next batch of oil, however much they bought, you know, if they bought a month worth, 3 months worth, 6 months worth. I saw Michael O'Leary, the CEO of Ryanair, the other day talking in an interview, and he said they bought their crude oil at $67 a barrel out through October of 2027. So their prices are not going to budge. Their jet fuel is paid for out that far, right? People have to understand that, you know, your gas station doesn't go, oh, we need a truck, send it. It's months of supply that's already bought. And if you start buying less of it, the prices go down because the gas station's orders start piling up and coming in, right? So they're reselling some gas stations to other gasoline jump men. There's all kinds of things in between that go into a price. Plus, 3 barrels of oil makes 2 barrels of gasoline and 1 barrel of distillates. You don't even get an entire gallon of gasoline from a gallon of oil. So the equation is a lot more complex. We don't even need to go into the gas tax issue. That's a whole nother thing.
For sure. It's an interesting discussion because, you know, again, something is you know, just straightforward as gasoline prices and where everybody, you know, thinks things should be and where everybody feels that everything is expensive. And I mean, it's just a funny discussion. I actually have a friend who is in the insurance industry, but he always tracks gas prices and tries to predict recessions from his spreadsheet. And it's kind of a funny thing, but it's interesting how that is looked at and how that is done, because I mean, so many things, you know, people love to talk about, well, I used to pay 50 cents for this and now it's $3, right? And it's never going back to 50 cents, right? But we somehow have this expectation that oil prices, which do tend to go back and are very cyclical and don't go up and up and up forever. And it's there's so many interesting things with oil, and I love the discussion, but we won't go too tangent-y on that one. I think that's an interesting one, but very, very cool. So tell my listeners kind of how they can keep up with what you're doing. It looks like you've got some, you know, you've got a website and you've got obviously your X profile and some live streams, it appears.
Yeah, so X is the best place to get a hold of me. If you follow me on X, it's you can see my name here, but it's Bob_Iaccino. That is an IA, not an LA. People screw that up all the time. So it's Bob_IACCINO on X. The second and probably best place is we have a website called The Unfiltered Investor, and we have a newsletter called The Unfiltered Investor Newsletter. Now, in that newsletter, we cover fundamentals in the first paragraph. I've teamed up with Jim Iorio and Mike Arnold, 2 guys that I've actually done business with in one way or another for about 30 years each. Mike Arnold is the best technical analysis I've ever been around in my life. And Jim is Jim. He's just like, he's a fun, smart guy.
Jim is Jim.
Jim is Jim. So Jim writes a fundamental opening to the newsletter. Mike writes his key thoughts. Then we have about 7 or 8 pages of charts that Mike puts out with key levels for each one of those charts. He does the NASDAQ, the S&P, the Russell, the dollar index, crude oil, gold. I believe that's it. Every once in a while, you throw something else in. We watch a lot of market breadth in that newsletter. And then we have what we call the map, which is our open positions from the previous newsletters and trade recommendations. And those recommendations have how to enter the trades, what price or better to enter them at, usually 3 targets. What we usually do is the first target, we do trailing stops on all of these. So every week we update where the stop should be. And then it's target 1, target 2, target 3. Guys decide however you want to exit it. But what I usually do is I move the stop after target 1. I take about 40% off at target 2 and the balance up at target 3. The math works for me for reasons we don't have time to go into. And then at the end, Jim fills out what's important to look at the very next week. So that's Unfiltered Investor. Right now, it's $99 a month. We produce it every Sunday, so you get 4 to 5 a week, depending on how many a month, depending on how many Sundays there are in a month. It's $99 a month, but we have a $1 for 2-week trial going on. It's basically a permanent trial, right? It's not something we're gonna, not that, oh, get in there because it's gonna go away. It's not gonna go away. You can take your time. And then we have, I have 2 podcasts that I do with Jim Iorio. One is called the Finance Unfiltered podcast. And that is everywhere. It's on YouTube, Spotify, Apple, Google, Amazon, iHeartRadio. And we also we do that podcast live on Monday at 3 p.m. Eastern time on X, Rumble, and YouTube. and then it's their evergreen about a week or two later on all the other platforms. And then there is a brokerage called Tradier, and they have sponsored a show that we do on Wednesdays at 4 p.m. That is a live show. And then I think they put that out evergreen on their Tradier hub and on their YouTube channel as well. So there's a lot of places to find me. If I annoy you, don't look for me. But if I've given you any value, I'd like to continue giving you value.
For sure, for sure. We'll make sure to post all those links for everybody to click on.
And you promised to come on one of those. Remember, Jared.
I'm happy to. Happy to come and chat, and let's talk markets. It's my favorite thing. So that's great. And thanks for joining us on the podcast today. I think you had some great takes on things. It's always, like I said, probably before we started recording, nobody looks at anything the same way. And I keep thinking the next guest is going to sound like the last guest. And it's been so far from the truth, which I love. So thanks for sharing some outlooks on everything and some thoughts. And we'll have you on again in the future. And I'd love to be on one of your podcasts. So thanks for joining us, Bobby.
We'll definitely get you on. And thanks for the invite, man. Good to talk to you.
Excellent. Thanks so much.